Are you tired of listening to expert financial advisors who claim to have a secret sauce for earning big returns in the stock market? Do you want to take control of your investments without the stress of picking individual stocks or timing the market? If you answered yes, then John C. Bogle's The Little Book of Common Sense Investing might be just what you need. Bogle, who founded the Vanguard Group and pioneered the idea of index funds, has written a gem of a book that lays out a simple yet powerful approach to investing that anyone can follow. Here are 3 key takeaways from the book. 1. Don't try to beat the market, join it. Bogle's central message is that trying to beat the market by picking individual stocks or actively managing your portfolio is a fool's game. The vast majority of active investors underperform the market over the long run, and the fees and costs associated with trying to beat the market eat into your returns. Instead, Bogle advocates for investing in low-cost index funds that track the broad market. By doing so, you're effectively buying a slice of the entire market and benefiting from the collective wisdom and growth of all the companies in it. In other words, Bogle urges us to stop trying to be heroes and instead be humble, patient, and disciplined investors who stick to a simple, diversified, and long-term investment plan. That may sound boring or unsexy, but it's a proven way to capture the market's long-term returns without taking on unnecessary risks or fees. 2. Minimize costs and maximize returns. Bogle is a fierce advocate for low costs because he believes that fees and expenses are the only reliable predictors of mutual fund performance. He argues that the best predictor of a fund's future performance is its expense ratio, which is the percentage of assets that fund managers charge investors as fees. To show the impact of costs, Bogle shares a stunning statistic. If you invest $10,000 in a mutual fund with a 2% expense ratio and earn a 7% annual return over 50 years, you'll end up with $174,000. In contrast, if you invest the same amount in a fund with a 0.1% expense ratio and earn the same 7% return, you'll end up with $1.17 million. That's a difference of more than $1 million due solely to the impact of fees. Bogle argues that the only way to guarantee your fair share of stock market returns is to keep your costs low and invest in broad-based index funds that have low fees and are tax efficient. Every dollar you save in fees is a dollar that compounds in your favor over the long run. 3. Ignore the noise, embrace the art of simplicity. Finally, Bogle urges investors to tune out the noise, distractions, and hype that permeate the financial media and focus on the art of simplicity. He reminds us that investing is not a game or a race, but a journey that requires patience, perseverance, and perspective. He encourages us to develop a long-term plan and stick to it through good times and bad, resist the temptation to chase hot stocks or fads, and avoid the pitfalls of market timing, speculation, or excessive risk-taking. Bogle's approach to investing is not about maximizing short-term gains, exploiting market inefficiencies, or predicting the future. Rather, it's about building a solid foundation of low-cost, diversified, and tax-efficient investments that reflect your goals, risk tolerance, and time horizon. By doing so, you'll avoid the pitfalls of trying to be clever, outsmart the market, or beat the odds. In conclusion, The Little Book of Common Sense Investing is a must-read book for anyone who wants to take control of their financial future, avoid the pitfalls of the financial industry, and achieve their long-term goals. It's a book that speaks to the heart of what it means to be a smart investor, humble, disciplined, patient, and focused in the long run. Whether you're a beginner or an experienced investor, Bogle's wisdom, humor, and guidance will inspire you to do the right thing and invest the right way.